Now, while still bullish on gold at the open of January trading, Goldman, at the open of January trading, pushed out their $3,000 gold price projection all the way out to 2026. And that was based solely upon synthetic market expectations, rising dollar and bond yields. That could be through rate cut expectations being diluted, etc., etc. This is going to cap gold from rising to 3,000 in the short term. That was their rationale. They openly said that. Clearly, they don't like competition, and they're using the Trump tariff uncertainty as an excuse. And they're going to be proved to have driven the price to 3,000 by the end of the first quarter. And they'll come out and say, yeah, well, things changed.
According to industry veteran Andrew Maguire, a renowned expert known for uncovering manipulation in gold and silver markets, traditional market relationships are undergoing significant transformation in the ever-evolving landscape of precious metals. Despite maintaining his bullish outlook on gold as January trading commenced, Maguire's analysis has been tempered by Goldman Sachs' recent decision to postpone its $3,000 gold price target to 2026. During Monday's American trading session, the precious metals market demonstrated its sensitivity to global events as gold retreated below $2,760. This movement primarily reflected growing concerns over potential trade wars sparked by uncertainty surrounding President Trump's tariff policies. Market participants remain particularly attuned to forthcoming central bank announcements, which could significantly influence the trajectory of precious metals prices. A significant shift in the relationship between precious metals and dollar bond yields is emerging. Typically, rising bond yields boost the US dollar and suppress gold and silver prices. However, current dynamics show gold and silver maintaining positive correlations with increasing yields, driven by accelerating global de-dollarization. The transformation began in November 2022, when strong dollar conditions led to higher valuations for gold, silver, and dollar-denominated commodities. Maguire calls this a perfect storm, marking a breakdown in traditional inverse correlations and signaling a fundamental shift in how precious metals respond to macroeconomic factors. In 2022, market analysts had projected substantial appreciation potential for gold, citing mounting inflationary pressures and expanding U.S. debt levels as key drivers. Their forecasts envisioned gold reaching $3,000 per ounce within 5 years. While these projections may still materialize, the timeline for achieving such targets appears to be extending, as evidenced by recent revisions from major financial institutions. As historical correlations evolve due to global economic forces and de-dollarization, investors must adopt their analytical approach for effective portfolio management in this new environment. Before we continue, subscribe, hit the bell icon for updates, and share this video with friends or anyone who might find it helpful.
And as we've relayed in previous episodes, it's not just central banks and sovereigns hedging dollar exposure, it's pension funds, fund managers who've got trillions under management. And if you remember, we drew attention to UBS, we drew attention to Swiss pension funds and others. Now, I've had so many questions, though, on this. So let's look at the effect of this through physical market lenses and step through what has led to this and why this will ultimately shake gold and silver free of COMEX-driven paper shackles. Now, what is not being factored into current gold and silver price forecasts is that physically settled global gold and silver exchanges outside of the cash-settled LBMA CME ring fence have now become, and this is important, sufficiently liquid enough to break free of these historical inverse dollar and bond correlations. Now, while still bullish on gold at the open of January trading, at the end of the year it was, end of or throughout 2024, Goldman, at the open of January trading, pushed out their $3,000 gold price projection all the way out to 2026. And that was based solely upon synthetic market expectations that a rising dollar and bond yields, that could be through rate cut expectations being diluted, etc., etc. This is going to cap gold from rising to 3,000 in the short term. That was their rationale. They openly said that. Now, truth be told, though, footprints affirm that Goldman Sachs are very long both physical gold and silver for their own books. And par for the course, clearly they don't like competition, and they're using the Trump tariff uncertainty as an excuse. And they're going to be proved to have driven the price to 3,000 by the end of the first quarter. And they'll come out and say, yeah, well, things changed. Now, our physical-facing first-tier liquidity providers, and yes, and we talked about this last time, one of them is a market maker at Goldman Sachs. They're betting that the forced unwind of dwindling COMEX open interest flowing into the physical settled markets outside the COMEX LBMA bubble, which they do see, will continue to evidence the dumping of US Treasuries for gold alongside central banks capitalizing on swapping the strongest dollar since November 2022 into physical gold. Now, this exacerbates the break in historical inverse correlations. In fact, liquidity providers expect safe haven gold and silver will continue to be positively correlated to rising dollar bond yields, while also benefiting in de-dollarization flows into gold and silver. So it's a perfect storm. And add in the corresponding alchemizing of a November 2022 strong dollar into gold, silver, and dollar price commodities. Gold sub $3,000 is considered to be way below fair value. And hence, central banks continue to capitalize on every fix sub this assessed fair value level.
Andrew Maguire reports EFP premiums at $40 per ounce above spot, the highest since 2002 when gold was $300. He notes that most arbitrage spreads will be cash settled, not leading to physical gold transfers from London to COMEX vaults. The market remains volatile, with London gold bullion trading at $2,661 per troy ounce, just $5 above Monday's two-session low. This followed U.S. producer price index data showing core inflation at 3.5% annually for December, a slight increase from November's figures, highlighting ongoing sensitivity to economic indicators. Maguire highlighted that tradable gold and silver volumes are much lower than reported. In silver, fears of Trump-era tariffs led to 23 million ounces flowing into COMEX vaults in 30 days, with spot silver trading at a $1 per ounce premium. Gold lease rates also rose to 3.5%, peaking at 3.9% intraday on Friday. Bart Mellick, global head of commodity strategy at TD Securities, provides additional context to these market movements. He emphasizes that the newly installed U.S. administration's proposed import tariffs of up to 25% continue to create ripples throughout commodity markets. Let's get back to the video.
So this is the futures chart for silver demonstrating exactly the same thing, where the short covering actually occurred slightly ahead of the gold short covering at the BIS. So clearly these guys were in the know of what was about to happen. So at current prices, and that is after we've seen a retracement and a higher low being actually cemented, we're still $13 or thereabout, $13.50 higher in futures contract terms. And that equates to silver having risen by $67,500 per 5,000 ounce contract. I'm just putting it into terms of where the futures markets prices have settled. So back to the spot charts. And what this evidences is that while gold and silver physical bars are completely unchanged in purity composition, it now requires over $1,100 more dollars to buy of more freshly printed dollars to buy the same ounce of gold, and it costs over $13 more per ounce to buy an ounce of silver. And that's in spite of being diluted by paper market inputs.
Now, the spike in US Treasuries being dumped by foreign investors demanding much higher rates will undoubtedly reappear in the next round of regional bank failures. Now, with debt levels so high, attempts to bail out these banks will see bond rates further breaking out, driving investors to repatriate these funds to invest in higher yielding money market funds. Now, the current widening EFP spreads, though, have drawn unwanted attention to the very tight physical supplies of gold and silver at current synthetically diluted prices. Now, nevertheless, tariff-related disruptions are expediting a supply squeeze in the silver and gold markets, leading to a spike in prices. Now, the largest above ground holdings of gold and silver reside in the COMEX-related ETFs, gold and silver ETFs. However, on and off ramps, occur in the risky, unallocated form. So none of these flows are as they flow in and out. And alongside the ability to short sell these ETF holdings, they are definitely not one-to-one physical equivalents, raising unknown counterparty risk double ownership concerns. And this means that at any point, real accessible physical free float is far less than is published. Now, fear of Trump tariff threats have been responsible for around 23 million ounces of EFP'd physical silver to flow into COMEX vaults over the last 30 days alone. That means buying spot silver to sell into a plus $1 per ounce higher COMEX price in many cases, alongside short-term annualized lease rates to loan out gold driven to around 3.5%, but as high as 3.9% intraday on Friday, which confluenced with the COMEX gold EFPs attracting as high as a $40 per ounce premium over spot, when really this close to expiry in just 4 sessions from Wednesday today, and essentially expiring really at options expiry on next Tuesday, should be about $3 or $4. So we see it as high as 40 sometimes of these premiums over spot. And that's the highest level actually since 2002, when gold was priced at $300. Now, what's not realized by many analysts is that the bulk of these very large arbitral spreads are destined to be cash settled, with very limited physical gold flows from London to COMEX New York vaults.
The recent rise in premiums and the growing reliance on cash-settled trades in gold and silver markets highlight a significant shift in market dynamics. With both metals' physical supplies constrained, the price surge reflects increasing demand amid ongoing volatility. The limited physical gold and silver movement and heightened premiums underscore the disconnect between paper and physical markets. Will rising premiums continue to impact gold and silver prices? Let us know your thoughts in the comments below. Don't forget to like, subscribe, and hit the bell icon for more updates. Thanks for watching.